And that is because fundamentals for high yield companies are still very stable at the moment. The technicals are still very supportive going forward, and we do believe that we've seen the worst in terms of tight credit conditions.
Overall, 2023 was a very positive market for high yield, but in 2024, the bullishness of many investors seems to have faded a little bit away from high yield and to investment grade. Today I have Loïc Depierreux from PGIM Fixed Income with me. Lovely to have you here.
Thank you for having me.
We'd like to get your opinion on the high yield space at the moment, because we've seen tightened spreads, very tight at the moment, maybe tight as they've been in a long, long time. Is high yield still a place to be?
Indeed, spreads are relatively tight at the moment, but I would say that they are tight for a reason. So corporate cash flows are still very healthy. You see companies still deleveraging. At the same time, the maturity of the high yield market is now at a record low level. And because that maturity is lower, you can also get less spread for taking less time risk. So there are significant reasons why spreads are tight at the moment. Now, our outlook is that for at least in the short run, we do expect spreads to remain range-bound from here at current levels, as we don't see any significant catalysts for spreads moving wider. And if there were a catalyst, then probably any move wider in spreads would be compensated by a move down in rates that would offset that performance.
So overall, is the high yield place currently a place for active management, and what added value can you provide for investors?
So looking at the current high yield market, it is a market where investors are looking at carry opportunities. We do believe that with bottom-up active management, we can outperform, especially when you have to consider that a part of that carry will be taken up by defaults. We do believe that with a good bottom-up process, we can try and find those defaults that add value and engage with those companies and avoid those defaults that don't add value for our investors.
We just heard in the discussion that many German investors prefer fixed income over equities. Can the high yield space be a replacement for the equity side for investors?
Definitely. At the moment, the yield on high yield is around 8%, and that's the highest it has been in a number of years. You also see that the bond yield is now higher than that of the equity earnings yield, which is also the first time that has happened in the past 20 years, not counting the GFC. So we're at a point where equities are no longer cheap relative to bonds.
In the discussion, we also talked about default rates and a possible recession. Are you still expecting a recession, and how will this affect default rates in general? Are we going to see higher default rates?
So at the moment, our base case is for a weakflation scenario where we do expect below average growth and slightly above average inflation. In terms of our default outlook, we do think that for US high yield over the coming 12 months, the default rate is going to be around 3%, and for European high yield, it's going to be between 2 and 2.5%. This is slightly above the current levels, but it is below long-term averages, and that is because fundamentals for high yield companies are still very stable at the moment. The technicals are still very supportive going forward, and we do believe that we've seen the worst in terms of tight credit conditions.
And you just mentioned US and Europe. Obviously on the equity side, we know that the US is a dominant place and a place to be. What's it like in your portfolio? How are you positioned US versus Europe and maybe emerging markets?
So at the moment, for our dedicated global high yield product, we have a slight underweight to Europe and an overweight to the UK. We do believe that spreads in the UK are a bit more attractive still. That is still the after effect from the Liz Truss mini budget debacle that happened. So that is where we like to be positioned at the moment. In terms of our EM positioning, we do have some room for off-benchmark EM positioning when we do see select opportunities within that space that we find attractive.
So overall, a very positive outlook for the high yield market, and it can be a replacement for the equity side, says Loïc Depierreux from PGIM Fixed Income. Lovely to have you here today.
Glad to have been here.